I searched and searched this morning. The best I can do to explain why, at least at this exact moment, Tesla is down sharply compared to the market is that the Cathie Woods are also down sharply. And I have no explanation for that. I mean, I really dug deep. I even asked Grok. I said, hey, Grok, what's the heck's going on here? Grok didn't come back with anything specific. So it may be a little bit of profit taking in these more speculative stocks, after a pretty good run up. I seriously don't have an answer for you, except that there's that interesting correlation, which I watch and nobody else does. This correlation with the Cathie Wood stock is commonly there. On other days, Tesla is more correlated to the NASDAQ, but at a 2 to 3 times beta or delta, I mean. Right now, today, it's really moving the same as the Cathie Woods, which, makes sense to me in a way. Mario Nawfal says that Elon has a phenomenal position in AI. That would be according to Jensen Huang. Of course, Jensen says that, but he goes into detail. He has a great advantage because his AI factory for cars is fantastic. He has a very large fleet of cars on the road. He's been working on it for a long time, and Tesla's working on autonomous vehicles, and I think he's working on exactly the right things. And, if you don't believe Jensen, who are you going to turn to? So it's a pretty nice thing for him to say. And in the meantime, the stock is down. The Boring Company, this is a related company, of course, they announced the Music City Loop. The Boring Company is coming to the state of Tennessee. The Las Vegas Loop has already moved more than 3 million passengers and growing. And the next step is Nashville. Thanks to the Tennessee Department of Transportation's and Governor Bill Lee, the Metro Nashville Airport Authority, and all these folks, they are going to help build a first stage, which will be from downtown to the airport. And then it might spread from there like it has been doing in Las Vegas. There's several other projects right now that are being discussed around the world. So the Boring Company is starting to get some traction. Also from Mario Nawfal this morning says Tesla's Megapack system to power, speaking of Las Vegas resorts. Estuary Power has launched a 185 megawatt solar and 400 megawatt hour Tesla Megapack battery project in Lincoln County, Nevada. The $98 million system will begin powering MGM resorts later this year. Phase 1 has already been done, and it supplies Caesars and Wynn Las Vegas under long-term deals. Who said solar's dead? And batteries are, believe me, the business is not going away. Barron says this. It says shares of Tesla, which is being thought of less as an electric vehicle company and more of a bet on artificial intelligence, robotics, and energy storage, dropped 8.1 last Thursday in the stock's first negative reaction to earnings in 4 quarters. Yet, the signals are positive. The signals are positive in terms of technical analysis. The stock has bounced cleanly off the round $3,000 level, coiling into a symmetrical triangle since May. This pattern could break in either direction, but the likelihood is that it will rise. Each upswing in the stock from its April lows has taken it past highs reached in the previous rally. Tesla was trading at 317 Monday with a breakout above 340 could ignite measured moves towards 440, while aggressive traders might nibble here, being sure to sell if the shares fall below 295. Now that sounds like extremely bad advice. So if you're holding the stock and it keeps on going down and it gets to 295, you bail out. Seems like if it got down to 295, you might hang on for a minute and try to buy it at 270, which is, I think, the low that we can expect anytime soon. Anyway, right now we are around that 317. I want to say, just for fun, I'm just going to look real quick, 320.71. So actually, and that is, we're still around the bottom for the morning. All right, Tip Ranks has this from Tom Narayan. Tom Narayan, he reconfirmed his buy rating on Tesla, raised his price target to 325. That would seemingly be something on a nice Tuesday morning that would have caused Tesla to go up, not down. Tom Narayan is a very respected analyst. Tesla may be facing some near-term issues, but RBC Capital Markets analyst Tom Narayan is keeping his eyes on what lies ahead. In a note to investors dated yesterday, Narayan reaffirmed his outperformed buy rating. Yeah. Whoops. Okay. The 4-star analyst acknowledged the short-term pressure in Tesla's core business. In the Q2 earnings call, Tesla faced a $300 million tariff headwind, mostly tied to its auto segment. There were also delays in launching the lower-cost Model Y due to expiration of the U.S. tax credits. That's a very weird paragraph. In other words, there was a delay that they made the smart decision to hold off because they want to use the lines, which are shared by the Y and this new product. Those lines are shared. They want to use those lines to maximize production of a higher price vehicle. Totally makes sense. Still, Narayan sees these as temporary issues and believes the company's long-term upside lies in the future bets, robotaxi, full self-driving, and humanoid robots. Narayan sees Tesla's robotaxi project as a major long-term growth driver. The company's first service launch in Austin has already expanded rapidly. Tests are now without any safety issues. Tests are now running in places like California, Florida, and Nevada. Tesla hopes to cover half the U.S. population by the end of the year. Narayan believes Tesla could outpace rivals thanks to simpler, more affordable tech and custom-designed robotaxi known as the Cybercab. If the rollout succeeds, he estimates the robotaxi business alone could generate $190 billion in annual revenue by 2040. Man, Narayan always thinks way out in the future. Alongside robotaxis, FSD is also gaining traction. Following a major update, the company said there was 25% increase in adoption rates. Tesla aims to launch this software in Europe, starting with the Netherlands, and plans to roll out unsupervised version for personal use later this year. I will add in specific geographies, maybe not nationwide. As for robotaxis, Tesla plans to show a new humanoid prototype. Robotics, I'm sorry. As for robotics, Tesla plans to show its new humanoid prototype by year-end and start production in 2026. According to Narayan, the robots will likely be used in Tesla's own factories at first, but the company aims to scale output to 1 million units a year within 5 years. Remember, each one of those robots that are used in the factory, once they're fully engaged, and especially if they can do 4 shifts, is worth $400,000 a year in replaced salaries. Think about that one. Cantor analyst Sheppard, according to TipRanks, sees Tesla's moves as another powerful signal of the company's strategic edge in the rapidly evolving autonomous vehicle landscape. According to Sheppard, Tesla's focus on expanding its robotaxi services marks a critical step towards solidifying its role as the front runner, it says here, I'm saying as the front runner in the competitive ride-sharing market. We expect robotaxi expansion into the Bay Area in the Q3, followed by Arizona, Nevada, and possibly Florida. He leaves out LA, subject to regulatory approval. Overall, we continue to see Tesla's robotaxi segment as a software as a service, high margin model, and we expect Tesla to have the ability to rapidly scale following commercialization. We expect Tesla will capture a leading market share in these industries. Sheppard continued. To this end, Sheppard rates Tesla shares an overweight, along with a 355 price target. And you would think that would be causing Tesla to go up today. Looking at the consensus breakdown opinions from other analysts right now on TipRanks, we have 14 buys, 15 holds, and 8 sells, adding up to a hold consensus rating. The 310 average price target indicates a 5% downside from here, but is actually a $10, almost $11 increase from where it was prior to the earnings call, where it was around $299, $300. This is Randy Kirk, by the way. I know we got a lot of news today. I got to get to that. So just hit the like button, would you? And then subscribe and notify, and Patreon. We need Patreon members. Okay, we really need to increase the Patreon. Just go down. It's so fast and easy. And it's only, you can do it for $3 a month. I mean, come on. You do $5 and $10 would be even better, but you can do it as low as $3. All right. Doge update from Rod D. Martin on X. He says there's a Doge update. $200 billion saved now. So for all the naysayers, oh, it's only $100 billion. Oh, it's only 140. Oh, it's only 160. Well, these guys are still working. And they're now at $200 billion on their way to that trillion. Says that's over 10% of the entire federal deficit, and it's 1/5 of Doge's goal in just 6 months. 12,426 contracts axed, 15,488 wasteful grants gone. Trump's Department of Government Efficiency is doing what DC said was impossible. And now this from Business Insider. Morgan Stanley sees the outlook for corporate earnings boosting stocks to new highs in the coming 12 months. After markets were battered in April amid Donald Trump's tariff announcements, earnings are getting a boost from a handful of sources. The bank said that April's price actions represented the end of the rolling earnings recession that began in 2022. Now we appear to be in a transition to a rolling recovery. I wonder if Kathy will use rolling recovery in her analysis this Friday. Remember, that's this Friday. And Larry and I will be having our program on Saturday where we analyze what Kathy would analyze. The rolling recovery backdrop aided by positive operating leverage. The AI adoption coming in, the dollar weakness coming in, cash tax savings from OBBBA, easy growth comparisons, pent-up demand for many sectors, a high probability of Fed cuts by the first quarter of 2026, or at least one or two between now and the first quarter. The bank's chief investment officer, Michael Wilson, wrote that list. The bank sees the S&P 500 rising to 7,200 in the bull case, a 12% jump from Friday's close. It also said the probability of such an outcome for the broad index is on the rise. Wilson said that high valuations that some observers have been fretting over appear to be justified. So the 22, 23 PE for the S&P is justified. The bank recommends industrial sectors as its top pick. He's not the only one. Several people have said that, even after it has seen it has already been the top performing sector. Major market indices have risen steadily over the past week, with the S&P 500 closing at record highs on July 25th. And how about 28th and probably today as well. Morgan Stanley's predictions come as economic uncertainty appears to be easing. You look at we'll talk about the VIX in a minute. With President Donald's announcing a new trade agreement with the European Union and the Federal Reserve expected to cut interest rates later this year, investors may be feeling more confident. They are indeed. The historically sharp inflection we're seeing in earnings revisions breadth confirms this process is underway, the bank stated. By the way, Bank of America put out a statement also where they think we're just about to have a boom, but the article was so poorly written and the analysis was so bad, I'm just not sharing it with you. Sorry. Market watch. The nation's trade deficit, are you ready? The nation's trade deficit in goods sank 11% in June to a 22-month low as U.S. companies grapple with on-again, off-again Trump tariffs, a pattern that's likely to play out for at least several more months. The trade gap in goods dropped to only $86 billion in June after $96.4 billion in May, coming in well below the street's forecast. Lower deficits add to GDP. The official scorecard for the economy. GDP is forecast to show a 2.4 annual increase in the second quarter. I think we get that number tomorrow, but the estimate could be raised in light of the surprise drop in the June trade gap. Imports declined by 4.2% to $264 billion, according to the advanced version of the government's monthly trade report. Exports slipped only 1% to $178 billion. U.S. companies have been trying to ramp up orders for imports when the Trump administration temporarily relaxed tariffs a couple of months ago. The strategy exploded the U.S. trade deficit to a record $162 billion in March, but since then, the trade gap has been sharply receding. All right, now this breaking news from the Wall Street Journal, U.S. home prices rose. All these things. The market should be going crazy. Well, it already has because it knows these things are happening way before they get reported. U.S. home prices rose at the slowest annual pace in 2 years as mortgage prices continue to stretch affordability. That's not the only reason. People are just waiting. They're seeing an opportunity. Things are off a little. And they're like, okay. Also, insurance rates. According to my real estate friend across the street, the insurance thing is a problem. The S&P CoreLogic Case-Shiller National Home Price Index, which measures home prices across the country, rose 2.7% in the last 12 months in April. That is the slowest on-year appreciation since mid-2023 and cooling from the 3.4% in March. Data released Tuesday showed. I think 2.7 might be exactly what I said on Sunday night. It was around there anyway. Mortgage rates continued at the mid 6% range through April, by the way, which is historically normal, keeping monthly payment burdens near generational highs. Generational highs, last 20 years, yes, but not historical. And pricing out significant segments of potential buyers, according to Nicholas Godek, head of fixed income tradables and commodities at S&P Dow Jones. The data suggests affordability constraints have hit previously overheated markets hardest, while traditional stable markets with more reasonable price levels are attracting renewed interest. So, but basically what you're looking at, I mean, I think the number one thing you're looking at is the price increases over the last several years have finally, you're finally just all you can get. That's just, folks can't afford more. We're witnessing a housing market in transition. The era of broad-based rapid price appreciations is apparently over. And I would agree, replaced by a more selective environment where local fundamentals are having a big impact. Across the 20 key U.S. cities, the price index saw a deceleration in prices, rising 3.4 on year in April from 4.1 a month before. That is huge. Economists polled by the Wall Street Journal expected a larger 4% increase, but I didn't. Breaking. One more breaking piece of news. All of this is positive. Oh my gosh, it's so good. It's like even an optimist like me is excited. Okay, the Conference Board Consumer Confidence Index improved by 2 full points in July to 97.2. The street was expected 97.4, so not quite as good. And the Present Situation Index, based on consumers' assessment of current business and labor market conditions, fell by 1.5 to 131, but the Expectations Index, based on consumers' short-term outlook for income, business, and the labor market conditions, rose 4.5 points to 74.4. Expectations remain below the threshold 80 that typically signals a recession for the 6 consecutive months. The what do you want to call it? The consumer out there, they're asking consumers, just average Joes, what do you think is going to happen to the business cycle? And these people are still theoretically predicting recession, where I don't think anybody else is. Consumer confidence has stabilized since May, rebounding from April's plunge, but remains below last year's heady levels, said Stephanie Gouchard, senior economist, global indicators at the Conference Board. In July, pessimism about the future receded somewhat, leading to a slight improvement in overall confidence. All these components of the expectation improved, with consumers feeling less pessimistic about the future, business conditions, and employment, and more optimistic about future income. Meanwhile, consumers' assessment of the present situation was little changed. They were a tad more positive about current business conditions in July than June. However, their appraisal of current job availability weakened for the 7th consecutive month. That's why we got that slight downturn. Notably, 18.9% of consumers indicated that jobs were hard to get, up from 14.5%. July's modest gain in confidence was driven by consumers over 35 years old and shared across all income groups except those earning the least. By partisan affiliation, confidence improved in July among Republican consumers and was stable for Democrats and independents. And we've seen this before, where this difference about what the Republicans think is going to happen compared to the Democrats is large. Gouchard added, consumers' write-in responses showed that tariffs remain top of mind, even though we are seeing zero evidence of any impact at all, and were mostly associated with concerns that they would lead to higher prices. In addition, references to high prices and inflation rose in July, even though consumers' average 12-month inflation expectations eased slightly to 5.8%. Down from 5.9 in June, with a peak of 7% in April. A number of survey responses mentioned the recent budget reconciliation legislation passed by Congress, referring to it as a big, beautiful bill, with some consumers praising its potential positive economic output and others expressing concerns. I wonder how that's split along partisan lines. However, the bill and its implications were relatively low on the list of themes that consumers were focused on in July. All right, we got one. Do we have just one more thing? And this might be the last one. I can't remember, but there's so much. I told you this week's going to be crazy. Investopedia. U.S. employers had 7.4 million job openings in June, down from 7.7 million in May, and the pundits had expected 7.5. The report matched expectations, but it was a little bit less. The labor market has slowed in recent months, dragged down by tariffs and high interest rates, although employers have avoided mass layoffs. I would say the labor market has slowed because it was overheated, and AI. How come this report doesn't suggest AI as a big reason? The job market sputtered along in June, staying in its recent low firing limbo. This is where it's been. Nobody getting hired, nobody getting fired. U.S. employers had 7.4 million job openings. The Bureau of Labor Statistics said the figure was slightly, we already saw that. Tuesday's report added detail to the Bureau's payroll report, which showed the economy added more jobs than expected. The unemployment rate fell, mainly due to an uptick in local government and education employment. President Donald Trump's unpredictable trade war has weighed on the economy in recent months. Uncertainty about trade policy has led businesses to hold off on investment and hiring decisions. AI. I'm sorry. Trump's wide-ranging new import taxes have also increased business costs and dragged on because sigh. Still, employers have held on to their existing workforce, avoiding mass layoffs. Trade policy uncertainty has fallen in recent weeks. That's true. Many forecasters expect the economy to avoid a recession, at least in the near future. Where is any mention of AI impacting jobs? Stupid. I'm sorry, it's just wrong. Trump is sitting at 48% this morning. That is up from yesterday. The VIX is at 14.86, dropping now under 15. I think it might even be lower than that right now. And the Truflation at 2.01, up 0.01. So basically 2% as yesterday, and the year over year continuing to fall under 2.1 now. And the VIX this morning at 14.86, about where I had it. Okay, so the VIX is really showing the risk on, getting more so every single day. All right, Tesla continues to be down 1.81%. I'm sorry, that's 1.61%, my old eyes, and now it's only 1.51. So this is improving even as we're watching. Let's keep watching. Maybe it'll get into the green. Anyway, with the Dow Jones down 0.22, the NASDAQ up 0.23, and the S&P up 0.1. So the markets are completely flat, and Tesla is down and not showing any evidence that it wants to really go up, although not going down more. Apple down a little, Amazon down a little, Meta down a little, and the rest are in the green in terms of the Mag 7. And as mentioned earlier, every one of the Cathie Woods, PayPal down 8.78%, Block down a full percent, Insignia down 1.75, TDoc down 3.92, CRISPR down 5. I mean, seriously down big numbers this morning. And what I think, I would take that and I'd say what? I'd say the bond market is screaming higher. But unless it's changed in the last couple of minutes, we're going to find out that that is just not true. Wow, something wrong here. I have got a mess on my... Here we go. The bonds are down 6.2 basis points to 4.358. Now, that's still super high, crazy high, but going in the right direction, down 6.2. How much more good news can you stand this morning? Well, oil is up 1.32 or 88 cents this morning, but it's 67.59, still in a fine place. Natural gas is finally rebounding a little bit, up 3.35 at $3.09, but still very close to that $3 level. You've got gold up this morning, but back to 3,323. It's been very volatile recently. Silver up 0.22, back up to 38.3. Copper also up 0.63, back to 565, heading back up. Well, it's nowhere near the $6 level. And the dollar is up against the euro and the yen. And Bitcoin up only 377, call that flat at 118,311. That's very flat, very been very flat for a while now. Okay, so after all that, where are we standing this morning? Well, Tesla, maybe it's just pure profit taking after a very good run up from that drop right after earnings. So quite a run up. So maybe a little bit of a pull down. I don't know. I've looked. I've told you all the good news about Tesla. I've told you all the good news about the market, and the market's flat and Tesla's down. So look, the S&P. I don't care what anybody tells you. The S&P is stretched. Okay. Now maybe the earnings all this week are going to make that look good. Make that PE come down a little bit, but right now it's stretched. Just believe me on that. All right, what do we got? We got later on today, CERN Basher, of course, is CERN is not coming up later today. Nicholas Gibbs is coming up later today. And then after Nicholas Gibbs, we'll have more Brian White, where he and I will try to be funny. Well, okay, he'll be funny, and I will try to keep up with him with an occasional jab here and there. And we'll actually try to bring you something of value also, which I promise you will be true. Now, if you missed last night's program with Brian White, it was good. It was really good. We talked about the Model Q. We talked about, is the Model Q the things that may not be in the Model Q if it's the stripped down version, which it appears is going to be, would you still buy the car? And I thought we had a great time with that. And I think if you go take a look, you really like it. So I'm going to put the card right here. I need to get out of here because this is probably the longest after the bell we've ever had. So I'm going to say adieu. It's been great talking to you.